So what company and product would you recommend? This is a question we get quite a bit, and in today's video, we're going to answer it with a case study, but we'll begin with a quick answer, which is if someone were to ask me, Steve, in general, what companies and products would you recommend for a whole life insurance policy that's set up for high cash value? My response would be this. I would start with one of the four major mutual companies, which are MassMutual, Guardian, New York Life, and Northwestern Mutual. The main reason why is because when we've looked at actual whole life insurance policies that have lived the test of time, meaning not just illustrations, but real policies and seen actual cash values delivered, we've seen those four companies consistently deliver strong internal rates of return on cash value and death benefit for that matter. So in summary, we've seen them perform, not just project good-looking numbers and then underdeliver. So that's the first point, company selection, one of the four major mutuals. And then the second, what product would I recommend? Well, it would be a whole life insurance product with one of those companies. And the product really doesn't matter as long as it's properly designed. I shouldn't say it doesn't matter because if someone wants to fund a policy for a shorter period of time, say it's 5 to 10 years, then I'm going to look at perhaps a limited pay product. Maybe it's a product that has more cash value up front. I'm going to show a couple different options there. This way the individual can see what's available before dedicating their money toward the product. But in all cases, the product would be set up for maximum cash value. We would aim to maximize the guaranteed and non-guaranteed values. And we'd look at a couple different products with a couple of the different major mutual companies. Our company primarily uses MassMutual and Guardian when we utilize the major mutuals. And the main reason why is because if you do things right, you can make the product very flexible. What I mean when I say flexible is you, the policyholder, has the ability to adjust funding as time passes. What I found a lot of people don't like when it comes to whole life insurance is being committed to a premium bill, where I've got to pay the same amount every month, every year. Kind of boring, and if life happens and I can't afford the premium for whatever reason, I don't want that to cause stress. So if I can set the policy up to be very flexible, that's a nice feature where now I can adjust my payments as time passes, and you'll find that MassMutual and Guardian accommodate that. The other companies do as well. However, just with what we know with Mass and Guardian and their flexibility provisions, we can typically maximize the flexibility, and generally speaking, people like flexibility. So let's actually provide a bit more detail on that with a particular case study. So this is based on an individual who had recently reached out. He owns a small business and he had stated that his cash flow fluctuates. Specifically, what he had mentioned, he had reached out via email, was that some months he does very, very well with his business and other months not so well. Things are up and down. So if he decides to take out a policy, he does not want the policy to feel like a burden, meaning he does not want to be obligated to make this big premium payment every year. So he provided that information and then asked the question to follow up, what would you recommend for my situation? And we get this question a lot, particularly with business owners. We'll see it with real estate investors as well. People that have strong cash flow, but it's not consistent. It can fluctuate, the timing that is. So if you've got slow periods here, what I want to make sure from a policy setup standpoint is that I'm not billed for a huge premium every month or every year. This individual did provide the dollar amount that he's considering. So he's interested in funding a policy somewhere between $25,000 and $50,000 per year. So what I would do specifically in this situation is show options with $25,000 per year going in and also $50,000 per year going into a policy. I would ask a number of questions before just saying, here's what you want to do, such as how long do you want to pay into it? Do you want to fund $50,000 every year? Or would you like to see a model where maybe you get 50 in for a couple of years and the others are 25,000? I do want to get a little bit more information first, generally speaking. But let's assume we have that for this example, $25,000 and $50,000 per year. So something we can look at here is what does a policy look like? If I fund $25,000 per year for 10 years, which is how much in total? 250 grand. And then what's it look like if I paid $50,000 per year for 5 years, which is how much? A total of $250. And then we'll show one bonus scenario, which will be the $50K per year for 5 years. That's set up, but we'll show what it looks like if he's not able to pay that dollar amount in, because the fluctuating cash flow is a concern of his. So if we can demonstrate that and show, here's what it looks like if you follow through and max fund it each year, but here's what it looks like if you can't get the dollar amount you think you can get into the policy, you can't actually get it in. Now you can see firsthand what it might look like, and that may influence your decision too. So with a case like this, flexibility, because he has slow periods, let's pick the $25,000 figure. In a case like that, what I would recommend from a company standpoint, among the major mutuals, I would show both MassMutual and Guardian, but if it's me, I'm probably going to lean toward Guardian. And the reason why is because if you set up a policy correctly with Guardian, it can be extremely flexible regarding the PUA rider. So I can set it up where my minimum commitment, this will be my base premium and also my term rider, let's call this premium, will be about $3,000. This is going to be based on a 40-year-old individual. That's $3,000 per year. Then I'll have the ability to add more money into my PUA rider on an unscheduled basis for another $22,000. But this is very flexible. I don't have to add it to the policy. When you add those two figures together, what do you get? The number he wanted, $25,000 per year. If we look at the $50K per year example, it would be very similar. My minimum commitment would be about $5,000 per year, and then I have the ability to add another $45,000 up to the total of $50,000. So let's take a look at both in this particular case, because what we're going to aim to do first is maximize the cash value. We want to make it very flexible because his cash flow does fluctuate. But if we maximize the cash value, that puts him in a position where if life happens and he can't continue to make payments for whatever reason, he's good. I've got the cash value maximized. It can pay for itself very easily. And if I want to borrow against the policy, well, now I've maximized my cash value so I can borrow the maximum amount. So if we look at the policy design here, this is the $25K per year for 10-year option. Let's take a look. And here's what we got. Make this a little bit smaller. There we go. Where's your money going? Up here is your premium. Right here is your term rider. So here, base premium. This does not build cash value in the first year. Term rider. This does not build any cash value. The minimum commitment are these two combined. Now, I did round up here because I didn't want an oddball number. So what we made the minimum commitment, the base premium plus this guy. This is a scheduled PUA rider. The scheduled PUA rider first covers the term rider cost, and then everything else is just kicked into PUAs. So if you add these two figures together, what do you come up with? $3,000 per year. So we set it up in a manner where he is only billed for the $3,000 per year. He could even set it up where he pays that monthly. So it'll be about $250 a month, a little bit more with the fees, but he can commit to the minimum. And then on an unscheduled basis, he can just throw more money into his PUA rider. So we're going to illustrate unscheduled PUAs, but this is optional, meaning he can add these if he wants. So Guardian allows this. If you set a policy up with their 1-year term rider, we can actually illustrate 10x the base premium per year going into PUAs. And you'll see that. So there's your base, multiply that by 10, and that's your PUA rider on the illustration when we combine the scheduled and unscheduled amount. So we can really juice the cash value, and that can be added on an unscheduled basis, very, very flexible. So as we look at this, 25 in the first year, cash value, just about $22,000. Next year, he pays in 25 again, grew from just about 22 to 47 and change, which means he got his 25 back and a little bit more on top of it. By year 4, he's paid in how much? 100,000 total. Cash value, just over 100,000. which means year 4 is his break-even point. Then after the 10th year, in this particular example, he stops altogether. So this looks good for a $25K per year flat funding amount. However, he wanted to see options, and then also we want to demonstrate what it looks like if you're not able to just max out the policy every single year. So let's look at another option here. Same product, but different design. Designed to handle more funding is the big difference here. So as we look at this guy, here we go. There's your premium. There's your scheduled PUA rider, which covers what? Term rider cost. Here's the actual term rider. So the purpose of a term rider, in case you're new to all of this, is it is a cost-effective way to increase your net death benefit, which increases the MEC limit on a life insurance policy. So the MEC limit on this policy is just over $50,000. That's our IRS limit. So we want to make sure the policy does not become a MEC, a modified endowment contract. That way we can avoid potential taxation on the cash value when we access it. There are other things that can trigger a taxable event, though, just to be clear there. Unscheduled PUA payments, $45,000. So this right here is a setup that we see a lot of business owners attracted to, because this policy, like what he's committed to, is the base and the scheduled PUA. So literally, this example, a clean $5,000 per year. If he's older, the term might be a little bit higher, and maybe he has to commit to $5,500 or $6,000 per year. But my point is, he wanted the ability to perhaps go up to $50K per year, but he was nervous that it might feel like a burden. So if he's confident that he can hit that $50K during some years, but he's just not sure when, meaning I don't think I can do it on my policy anniversary date, my due date every year, that I'm not attracted to. But if I can do this, like pay this on my premium due date, and then add everything else whenever I want, so it's very flexible, okay, you've got my attention. I'm a bit more interested in that. So that's exactly what this shows. 50 in the first year, cash value, 44 and change, break-even point between years 3 and 4. What we did here was get the same 250 into the policy, but over a shorter period of time. And he can continue to make payments, but here we stopped it just to get the same 250 in this particular case. So let's take a look at a side-by-side here. This will be cool. So here are the two examples we just looked at. And this will just demonstrate the minimum commitment and such, just line by line. So minimum, there's the base premium, the term rider cost, that's the amount we set up to be the billed amount, $3,000 per year. We did illustrate $22,000 in unscheduled PUAs. So the net after-tax outlay on that illustration was $25K per year. Total payments, keeps track of everything you've paid in, cash value, and net death benefit. All right, fantastic. Same thing to the right. What I'm committed to, $50K per year total. Now, year 6 and 7, if we go back to the illustration, that $5,000 premium was still due, it was $4,500 and change. In this particular case, we did model a premium offset, which allowed the policy to be paid internally through dividends and interest. But I promise I won't get technical in this video, so I'll stop there. Break-even point between years 3 and 4. So let's transition into the bonus scenario now. Because if we go back to the overview in his situation, and he's asking what company and product would you recommend, because my cash flow fluctuates, I would gravitate toward Guardian, still look at other options. MassMutual has some advantages if you want to fund for a long time, but based on what you've told me thus far, I would gravitate toward Guardian because it's very flexible, and that should loosen the vice grips so you don't feel like you've got this big premium obligation. Now, what if you go with this option, but you don't get the $50K in every year? Because this model is really a best case scenario, assuming you're max funding it every year at the beginning of each year. When you see an illustration, it's going to assume PUA payments are made in the beginning, called the first month of each policy year. So if you're making them over the course of the year, those actual values will look a little bit different. Now, to make things even worse, check this out. Not worse, but just more awareness here is the right word. So on the left, we've got the policy we just looked at, which is the $50K per year for 5 years. But on the right, you've got the exact same policy, but illustrating what it looks like if the funding truly does vary over time. We're assuming he picked the option that has the minimum commitment of $5,000 per year. We're assuming in the first year, he did get another $45K in. Maybe he started off with a lump sum, paid $50K in right out of the gates. And as a result, you will see identical cash values in both scenarios. Where it differs, however, is beginning year 2. Now, year 2, I pay my $5,000 premium. I add another $10,000 into PUAs. My total out-of-pocket in year 2 is now $15,000. Here's my total payments over the first and second year. I like the total payments column a lot if funding's varying because it makes it easy. I can just see firsthand when my break-even point really is. So here, got to correct this actually, because the break-even is not year 4 in this case. Close, but it's really year 5 when I look at it, based on the company's present dividend interest rate. So there we go, positive year 5, where I've paid in a total of $135, and I've got $135. Look at your total payments compared to the example on the left, significantly less. So here was his plan. Here's what he actually got in this hypothetical scenario. So does he have to stop after 5 years because we modeled payments for 5 years? No. He can continue to pay. We stopped it after 10 years at age 50 in this example, but he can keep going. If he wanted to keep paying this $5,000 premium, he could actually do that up until age 95 with this product. So he can continue to feed the beast for a long time if he wants. Here, for the sake of keeping everything consistent, we put a total of $250 into the policy. This way I can just see, all right, if I pay in $250, what's it look like with each example? That's the total amount I think I'm going to get in or what I'm comfortable moving into the policy. After that, maybe I'll add money, but show me stopping altogether. It's a nice round number. Anyway, I hope this helped. To summarize, what would I recommend in his particular situation? If I'm him, I would gravitate toward Guardian. The product I modeled there was L95 because we can really keep that premium low, generate strong upfront cash value, strong guarantees, and decent long-term cash value as well. That would be an option I would gravitate toward personally. However, I would show a couple different options too. Just because where buyer's remorse pops up with whole life insurance sales, in my experience, is typically in a case where someone's shown one option, they're told this is the option, then they find out about something after the fact, and maybe they would have went with that, maybe not, but they said, I would have liked to have seen that, or why didn't we consider this option? So just putting myself in that position, when I see that up front, I'm able to pull the trigger on the option I'm most comfortable with. Doesn't mean you need to see everything, because it can be overwhelming, but enough options where it can make an informed decision. So I hope you enjoyed this. If you did, please hit the like button, subscribe for more. Let us know if you have any questions or comments below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.